Hey Whitney, how you doing? Hey Yanko, how are you? Hey Damien. So dollar news incoming. I think this was expected, I kind of said this on my weekly watch list that this was the key area where price would kind of pull back from. Hey Mills. And I think we just have more weakness to come. I think the Fed will come out, and I don't really think we're going to see much of a spike or anything during the actual rate release at 7 o'clock. I think the expectation is 5.25 for it to stay the same, and I think that's what's going to happen. I think if anything, the market might see a bit of a downturn, but I think the key is going to be the wording during the actual monetary the actual meeting at 7:30, which I think, he might not categorically come out and say they're pausing, but I think any kind of dovish language will just send the dollar down. And dollar weakness has always been my prediction for the last several weeks and months overall. We've had that. We know Euro USD from a weekly perspective is in a retracement phase. So we know that Euro was heading to the top side. We know the likelihood of where the Euro was heading was in that region of 1.16 to 1.18. We know it's working its way up there. We know the same thing with the pound, and we know the dollars had strength for a very, very long time. So that weakness was pretty inevitable, and with the Fed now losing steam, that's just inevitable that we see the dollar pulling back, coming down. And again, people sometimes get things confused that they just think, oh, it's just going to be a full off sell off. Yeah, I think for the next couple of months at least, we could see definitely dollar weakness in terms of a longer term trend. Like Euro USD, how long have we really been bullish for? We've been bullish since October 22. That's where we kind of bottomed out here, and then we started to push to the top side. So it was inevitable, and we call this daily pullback pretty perfectly. We had that pullback, we had this push up, price perfectly came into our fib confluence, and then we started to push to the top side. So where's the next push? The next push is to take out the previous high and create a new high before we kind of see this and price continues to the top side. So I think that the technicals are just going to align pretty nicely with the fundamentals. So there's no real surprise in my opinion, unless they come out and they say, the data is still pretty not where they want it to be, and they're going to review it, and they've not taken they've not completely decided to pause, and they're not at their terminal rate, then we could probably see some bullish sentiment. But I think even that will be short-lived. All that's going to allow us to do is wait for some pullbacks to continue buying. My overall perspective is going to be that. So for the likes of Euro USD, we can see we had this breaker structure here. After this, we have not really seen a pullback. You know, we've had these internal pullbacks, but realistically, we have this low to that high. So we have a nice area of demand at like 1.07, where if we do get some bullish sentiment from the Fed, I'll be happy for price to head back down into this region in a discounted zone for me to continue buying. Because fundamentally, regardless of what they say today, longer term, you have to remember the Fed is winding down. So whether they come out and it's like, oh, we might do another one rate hike, yes, you'll see the dollar spike, and you'll see the likes of euro, the likes of GU, dollar crosses come down, but that's just going to be pullbacks. It's the same thing with AUD USD. You know, look at AU. What did we say? We perfectly said that this was our daily area of pullback. You could see price wicked into that 50% zone. We already discussed the weekly, that the weekly's in a pullback after the weekly created this. And now we're pushing off to the top side like this. So we had already factored this region. And look, we perfectly mitigated this. And what did we say? We said we needed price to close above on the 4 hour for this daily pullback. Sorry, this weekly pullback on the daily trend to have come to an end, which it has. You know, we've had this break now on the 4H. Sorry, I'm just going to update this. So we've perfectly had that on the daily. So now going down on the 4 hour, I have no real interest in expecting price to come down and mitigate this 4 hour level of demand. I'm not saying it can't do that, but the likelihood is it's not going to, because if it was going to, we would have continued to see the 4 hour stay below this and not break the previous high. So where now we've broken a previous high, I'm not saying we cannot see a retracement. We probably will see a retracement. Now, if we get some strong news for the dollar and we start to see price coming back down, are we looking at buys potentially back up from the 0.65300? Because now we've created a lower low and a higher high. So now this low should be protected. We know it's coming to this significant area of the swing pullback, and we've now shifted and broke above this lower high. So structure is now shifted. So any bullish dollar news, all it's going to allow price to do is kind of retrace. But longer term, I think there's dollar weakness, and that's the reality of what it is. So irrespective of what the news is today, the way I see it, if there's strong news for the dollar, then it's just going to allow price to pull back, and all that's going to mean is if we start coming down on like lower time frames, if we start to see price break through areas of demand and pull back, we can start to trade price back down after this huge expansion. But if there's weak news for the dollar, then what we can expect is this 4 hour push to continue. You know, and overall then, that just defines where do we expect price to be going. Target 1 is going to be, if we look at it from a daily perspective, we had our lower low, marginally broke above that pullback. Our first target on the daily should be a break above this. Now let's see, we've got literally a few seconds before the news is coming out. Let's see what happens. Let's see what comes in for the dollar here. Now gold, I want gold to break out of the range. You know, gold is stuck. You know, we created a lower high, lower low, and then we've just been in this range. So I'd like to kind of see gold break out one side or another. So original push down on gold. Seen some bullish move for the dollar. So again, it's come out at 5.25 as expected, which is not a surprise. Not a surprise at all. Now, personally, what I would like to see, I would like to see gold selling off, come down to mitigate this area of demand. Now, does it do that, or does it respect this zone? Well, it's breaking through, as you can see. Let's go down to, there we go, we can see remember guys, don't FOMO into anything. Be patient. And you can see we have this kind of low, pulled back, reacting to this swing point here. Yeah, it could be, but like I said, I would much prefer the dollar coming all the way back down into this area, which it is again. You know, I would much prefer it coming down to like 1935 and hovering around here, and then seeing what it does, because that's a unmitigated, it's an unmitigated hourly demand. You can see, and we have, you know, we have liquidity resting below here, we have liquidity resting below here, we have liquidity resting below here. So, and then we also have liquidity resting above all of these areas. But does it come that far down? We'll need to wait and see, or does it just respect this structure? NASU, I'll have a look at NAS for you. Just seeing what gold does over here. And I don't typically look at the 1 minute, but when you have high volatile news like this, I'll have a look at it. Let's have a look at NAS. Now, a pair to look at, guys. This is great, right? I was looking at Euro AUD. Right, let's look at Euro AUD. Look at the daily chart. We had a daily break, so we're expecting a daily pullback. We got this daily area of demand after this 4-hour break. So we have great room from this daily demand zone for a pullback. Now, what I was waiting for on a 15-minute, you could see we came into this area and we kind of created some structure. We had this push, we had a break below, and now we're having a nice change of character from this daily demand, and we're creating a nice area of demand and a break above. So with this break above, retracements back into here, we have lots of scope to trade back up into this. Mark this high to the low. You can see this perfect area of 1.63500 is a nice region for price to continue pushing up into. So this will be a nice trade. Look at that. Dollars coming down. I mean, we have gold coming down. Let's sweep all of this and see what happens. So let's go to what did we have? We had NAS. Let's look at NAS. NAS is dropping as well. Now again, we're reacting from that 50% of that daily area of supply, and it's a daily swing high, so there's going to be lots of liquidity resting above here. Now again, you know, I'm not overly keen on buying or shorting this, because we could see a pullback and then a continuation to the top side. Now for me, we really need to see some deeper retracements in order to really get long on this. Like, we have our daily swing from the low to the high. For me, price kind of somewhat needs to head back into these regions from a longer term perspective to start buying. Intraday, we currently have, the way I see this is I see this as a build up of liquidity, somewhat equal lows. So if we kind of look at that as the last pullback and look at this, I'll be more inclined to look to buy this if we kind of get down into this region, into like 13,900 area. Look at gold. Now again, remember guys, how many people are going to be thinking, oh, let's just start shorting into this, let's start shorting into this. But no, make sure you're patient. But if we look at NAS on, like, say, like a 15-minute chart, even to start looking for some shorts, what you want to see is we had this last low and then we had this push up. So you really want to see a break of this low, and then we've created some supply here. So if you can break this low with a retracement, we could start shorting from this daily area of supply. So lots of opportunities once you understand structure. Look where it's rejecting from right now, and I'm not saying it's going to continue higher, but we have this area of demand, and this is the current swing structure. We had our pullback and we had this high, so it's currently bouncing off of this area right here. Look at that AU, nice. And what does this do, guys? This is great stuff for us, right? What does this do? It just creates opportunities. We already know from a high time frame perspective we've shifted bullish. If we break structure here, we close below, we've entered a nice, we can start to wait for price to head back and start trading the pullback. But you don't want to start trading anything before the news comes out, we hear what they have to say, and then the news settles. Trading news itself is never great. You know, you're never going to become a profitable trader sitting there trying to gamble your money with news. Now, I'm not too sure if anyone else managed to catch this trade, but I took partials off just at this region here. So I closed 70% of my trade at like 57 pips on CAD CHF. Another one that was on the weekly watch list. Indeed, it creates imbalance, it creates inefficiency. Now, how many people are just like, oh, let me sell, let me buy? It's just like, you're just going to get caught up in rubbish. Like, especially with a pair like gold, when you know that it's pretty much all of this structure is sideways. There is no significant high or low. Everything is internal. So why sit there trying to trade something when there's no clear direction? Just let it be. Let's see pound. Now again, you know, what's the pound doing? So you could see this was the daily swing high for pound. And right now, what have we done? We created an equal high. So we've not broken that high, but the likelihood is that's where price is heading. So again, similar scenario with pound. We had, well, I'm on the 8-hour time frame. We had high pullback. We then had this high. We had this pullback, but it wasn't deep enough for me, and then we did this. Hey, Joe. Joe, did you catch some of the move on CAD CHF? I know it was one you were asking for on the lower time frame. There was perfect entries on that one. Now, pound USD, similar thing. I'll be more interested in longing this if we can get a pullback into like 1.24563. Now, we do have an area of demand here. But this wasn't a deep enough pullback. I see this as the entire... I see this as the entire push. So retracement into that. Sweep liquidity under this would be great. Nice, nice. So did I. I caught that move myself. I closed... I was just mentioning it. I closed like 70% of my trade at like 0.67500, 513 kind of region. But I've still got like 30% running. I'm just going to see what Fed leaves rates unchanged. Estimated statement compare. Add window. Now you can see all dollar did at this point was pull back into this area of supply. Nas and Twitter. NASA. I follow Nas. No, is it Nas? Who's that? Nasdaq, the ticker. Nah, I don't know. This will be interesting. Do we see a pullback and then a sell-off down into this demand? Interesting, interesting. Okay, that pound is still selling off. What's AU doing? So we have like, turn this music off. We have like 15 minutes. Before the press conference. We'll watch that live. See what USD CAD is doing. I'd love for Nasdaq to break and then coming into tomorrow look for some shorts. You know, these are due for some pullbacks. Look at that. Look at US 30. Great sell-off from this extreme supply. Now again, you know, where could we expect to kind of see this shorting down into? Into like 33,060 kind of region. So again, looking at this on the chart here, we have some clear levels of supply created. So pullbacks and continuations down into that region will be fantastic. Has anyone FOMO'd into a trade? Be honest. Euro AUD, guys, this is going to be great, in my opinion. If we get a pullback before we approach this area of supply, that will be kind of target one. So if we go into the 15-minute chart, we've had a nice change of character now over here. Now say we start pulling back from here for argument's sake. Perfect area of imbalance, unmitigated demand. In that daily area of demand, we have that region up here at the top that we just spoke about. What kind of gap is that we've got to work with? It's like 150 plus pips if it pulls back from this point. You did, Whitney. Well, at least you're honest. What did you... Well, first of all, did you make profit? If you did, good. Well, I wouldn't say good if you made a profit, because you want to stick to your rules. You know, you do not want to be trading just like that. Let's see what Euro USD is doing. So again, just putting back into an area of demand. Good. So we have 9 minutes left till FOMC. We wouldn't be surprised if prices are hovering around in these pullback areas. Powell comes in and boom. There's GU. Now again, we could see, the dollar coming back into like 104 before the next sell. Because if we look at this on a 4-hour chart, we had a push down, we had a pullback, we had a breaker structure here, we had a minor pullback, and then we did this. So we kind of can just say we had this big push down, we have this area of imbalance over here, this unmitigated supply. So we could see price pulling back into that region quite nicely. Let's have a look at NAS again. NAS is hovering around. So we have some tweets that say Fed says holding rates allows FOMC to assess additional data. Fed pauses rate hikes but signals more tightening to come. Fed median rate forecast rises to 5.6. Fed says extension of additional firming to hinge on economy. That's interesting. So, that could be a catalyst for some dollar strength, which again, as we mentioned at the start of the stream, if there is some bullish sentiment, that's going to allow some retracement on these pairs, which is absolutely valid, but longer term still means bearish dollar in my opinion. Now remember guys, for me, in relation to gold, if gold cracks this low here, then we have a high probability of gold heading down towards 1840 kind of region to fulfill the daily pullback, which is this. Then I'm not going to be really concerned about these areas of unmitigated supply and areas of imbalance and stuff. Then this will become our swing high, and then we'll kind of have a low, and then we can expect price to do this, and then from here we can potentially see price kind of reversing, because on a 4-hour chart, like, where's our next area of unmitigated demand? We do have a demand down here at 1920, and then the next real significant demand sits down at 1840. So the demand zone at 1920 could be a catalyst for a minor pullback, but then a continuation down. You could see sideways price action. Right, 3 minutes. I'm gonna get this up on the let's get rid of that. Right, can you guys see the window for the YouTube stream for FOMC? Do need to shrink this slightly. So I'm just gonna mute myself, guys, while we watch this. If it's not loud enough, then just let me know and I'll see if I can put the volume up.
afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25% and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a half percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Colby. Thank you. Colby Smith with the Financial Times. I'm curious what gives you and the committee the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So, I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were 3 issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots. Stronger GDP, less of a hit to unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So, although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year will contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a sector, it's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive, and I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend, It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing.